discuss the texture of the market. Sandip Sabharwal as well joins in on the show right now. Sandip, hi, good morning. Good to have you on the show as always. Sandip, wondering whether the moves on IT would continue today because Wipro too has been a disappointment, at least given by the PAT performance, not so much the revenue and the margins. They were in line. But do you think we can see a follow through?
In the IT sector, it's unlikely that we'll have significant gains from current levels simply because of the fact that this entire versus over trade, which is being played in the market, is, in my view, a fallacious one because the worst is clearly not over. The discretionary cut down has just started. This is the first quarter these companies have actually started accepting that. It should last at least 2 or 3 more quarters. So there's not going to be any positive earnings surprise coming through. Secondly, given the way the dollar index has fallen and it looks like the US dollar index will decline further, there's a probability that the rupee might actually appreciate over the next few months. So a tailwind for their margin, which was helping them, which was rupee weakness, also might not be there. So I think the headwinds are greater than tailwinds. So I would not be too aggressive in IT stocks at this stage.
Yeah, not too aggressive.
Bank, what your take has been on the quarterly performance?
Yeah, so I think the federal bank results reflect what's likely to happen, especially in many of the smaller banks going forward this quarter and the following quarters, where margins will get squeezed as the cost of deposits move up because given the way the structure works, their lending rates are linked to the benchmark. So the lending rates move up immediately, deposit rates follow. CASA deposit ratio has fallen drastically, which we'll see in many of the other smaller banks and also PSU banks. The street has been very gung-ho on PSU banks. I think we'll see a reflection of this coming in many of the PSU banks also. So after the big move in the bank Nifty, which we have seen over the last few months, it's better to stick with the leading larger banks because they will be a bit insulated from this, although their names will also come under pressure, but not as much as what we are seeing in smaller banks.
Okay, meantime, let's watch action in the primary markets of late. What you've perhaps made of some of the recent new age tech companies, the kind of performance we've seen in Zomato, the concerns that have been flagged off by brokerages as well when it comes to some of these names, delivery, etc. How are you looking at the businesses?
Yeah, so what we've seen is that we've seen a rally in these stocks driven by positive management commentary and some incremental reduction in losses. And that started off with Paytm, then got taken up by Policy Bazaar, and now some others are also participating. And Zomato was always the standout player in all these companies because it operates in a duopoly, and to that extent, at some stage, these companies should start doing well, although it's not reflected in the numbers yet. And we've seen the stock also rally to a 52-week high. So I think after these up moves, it's tough to make a case to buy. So I think when they were lower, most of us didn't want to buy them. So my view was 50, 55, we should be looking at Zomato, but I never ended up buying it. Now it's run up 50, 60%. So I think we'll just wait it out and see. At these prices, I wouldn't be the buyer in these stocks at all.
Sandeep, have you taken a look at Senco Gold at all? It's due to list today.
No, the IPO companies I don't look at immediately, so I think sometime.
Fair point. Well, it seems like it's going to be a big bang of a listing like Vinny was just highlighting, just taking stock of some of the other names from yesterday. It's the OMCs once again which are under pressure. Remember, crude is now all the way back to $81 to a barrel after the recent OPEC move. And that's really weighing heavy, or rather escalating crude prices further. Autos as well were a bit of a sideline yesterday. There was Reliance, SBI as well, which did not really participate in the move. And like I said, the only show of resilience was from IT, Bajaj Finance, and a one-odd ICICI Bank and HDFC Life as well, which managed to hold out. Sandeep, these insurance names have clearly managed to sort of rise from the ashes, seen a meaningful recovery since the budget lows. But would you recommend buying into any of them now?
Yes, I think the move was quite surprising actually, the way they moved up because the budget moves were clearly negative. Then a couple of months data on growth was above expectations. So I think that's led to this kind of rally. But again, these stocks now at these levels, ICICI Pru at 600 or HDFC Life more near 700, they don't really have value at these prices. And I think that's the challenge for investors in these markets because when a trend starts, some of these stocks move up 30-40%. That's the time people start looking at them. But then, given the overall growth outlook at those prices, then the value is not there.
Patanjali Foods, let's just bring up that stock price up for you because while they did, declare the OFS price at that at a base level of 1,000 rupees per share. Yesterday, of course, the stock tanked. Now, last evening, they said that they're not going to be exercising the green shoe option of the OFS issue. So this is going to be another stock which you may want to keep on your radars today as well. Angel One, good performance coming in there. We saw Anand Rathi as well perform extremely well in terms of their quarterly numbers. For Angel One, the revenue has risen about 18.5% on a year-on-year basis. The gross client addition as well has seen an uptick of about 2.5% sequentially. And Sandeep, quite interesting. I don't know if there is a trend here or whatever, but some of these market-linked companies or market performance-linked companies have had an excellent quarter.
Yeah, so because it's very clearly linked, Aisha, we've seen it all the time. Whenever the markets start doing well, trading activity, retail activity picks up, and like the first quarter was subdued, this quarter was better. So I think those trends will continue. So the key is that do investors want to buy these companies whose fortune are only linked to how the markets do, or they want to actually buy into companies where you can actually analyze the companies more granularly in terms of what they are doing is driving their growth. So I think that's the challenge. Overall, this industry is still facing margin headwinds and growing competitive intensity. So, and the PE ratios at this point of time are very, very high.
Yeah, the P ratios are very high. Kunal,
line has been. And Sandeep, many are circumspect about how long this rally in some of these railway and defense names is going to last. But given the kind of order inflows that one is seeing almost on a consecutive day basis, it doesn't seem like the story is anywhere near done.
I would agree with that. I don't think the story is done, but then it's also a fact that they have run up too much too fast. And they have run up in anticipation of growth, which will flow through over the next 2, 3, 5 years. So, to that extent, investors who are buying now and who did not buy earlier should be ready for corrective moves in these stocks, which could be sharp and which could be 10 to 30% also in some cases if the markets start correcting at some stage. So I think as long as investors know the risk associated with these stocks, longer term growth story is still there. And as such, because the visibility is so great, longer term, they should still do well. In the near term, valuations seem to have run ahead of what the performance is right now.
Vaishali, have you looked at any of the infrastructure names?
One, you think at least in the near term, the best could be behind us?
I think NCC continues to do well, given the fact that they've reduced debt so much and their order book is quite strong. I would still believe that they could be upside in NCC. People have been circumspect buying into some of the infrastructure companies because of the past experience. In the past, many of these companies flattered to deceive. And to that extent, I think broadly many fund managers, etc., have been reluctant to buy these stocks, whereas so the interest has been more on the newer plays like defense, new age, etc. I think on pure valuation and growth outlook, NCC still looks fine. I would still think that it should be able to give decent returns.
Okay, meantime, Sandeep, curious on your take on PVR Inox and given the fact that it has been in the spotlight with respect to the GST, now they've slashed F&B prices by about 40%, and then there's, of course, new releases like Mission Impossible. What's the take?
I think the entire sector has took a hit because of the failure of few large budget Hindi movies, despite the merger of PVR Inox, which should lead to cost synergies and improvement in outlook. So at these levels, I would be positive inclined. In fact, we are buyers in this stock at these prices. We are slowly adding to this stock because I think the negativity is at its peak, and we could actually see improvement in performance uh, as the fact that while very strong performance, movies doing well continuously is also an aberration. Movies doing badly also continuously is an aberration. Finally, going out, people spending on entertainment, etc. In India is only going to grow. And the industry is very, very consolidated now. So at these levels, I would be positively inclined.
Okay, so that's the take coming in as far as PVR.
HDFC gone, inclusion of LTI Mindtree. Just wanted to understand what's your anticipation on HDFC Bank, given that the numbers are due on Monday, and whether a bank now in its combined avatar as large as HDFC Bank combined, can continue to grow at the growth rate that it has been traditionally.
Firstly, I think Aisha, the growth will obviously slow down. I don't think they'll be able to grow so aggressively. And we could see the growth from 20% which they used to do move down to more near 15%. And they could still aim at higher than industry growth, although given their size, it will become tougher. The second part is that the integration creates several issues related to CRR, SLR requirements, priority sector lending, etc. And them having to raise deposits where it will be not possible to do that on the CASA front immediately. So it will be have to be more term deposits or through bonds. So the next 9 to 12 months could be challenging for the combined entity in terms of profit growth. And that's something we need to see. The management is strong. How they are able to handle it, we need to see. In the near term, I would think be a challenge for the combined entity. And as such, after the run up we've seen in the stock, we should see some consolidation. Big upsides are unlikely.
Okay, on that note, Sandeep, we'll let you go. Appreciate you joining us on the show today and talking to us about a whole host of sectors and stocks. The pre-open rate should just trickle in any moment now. It's 8:59. So we'll